You've been saving. You've been disciplined. Maybe you've built up $100,000 sitting in a bank account, but now comes the hard part. What do you actually do with it? Leaving it in cash feels safe, but deep down you know it's not doing much. Inflation is slowly chipping away at its value. And the longer it just sits there, the more growth you might be missing. And jumping into stocks without a plan feels risky, especially in the current economic environment. So here's the question: what if there was a smarter, simpler way to invest without needing to time the market, read financial news every day, or gamble on risky stocks? That's where iShares ETFs come in. In this video, I'm going to show you and John 5 of the best iShares ETFs available right now. Clear, balanced, and built for the future. I'll show you how much each of these ETFs can turn a $100,000 investment into. Fun fact, every one of them grows to over $2 million. I'll show you an ETF that pays over $20,000 in monthly dividend income. And in the end, I'll show you one of my favorite ETFs that can turn $100,000 into a $13 million portfolio. But first, how and why I chose these top 5 iShares ETFs. Choosing these 5 ETFs wasn't about picking the ones with the flashiest returns or the most buzz. It was about balance. I wanted a mix that can handle whatever the market throws at us, whether that's inflation, interest rate hikes, trade tensions, or tech booms. Each fund had to play a specific role, kind of like building a strong team where everyone brings something different to the table. I looked for funds with long-term performance, low fees, and a track record of resilience. I wanted exposure to different parts of the economy, steady U.S. giants, innovative tech leaders, consistent dividend growers, even a bit of gold for those turbulent times when everything else is shaking. And I wanted each ETF to stand on its own, but also work well together as part of a bigger picture. Most importantly, I didn't just want something that looked good today. I'm thinking about 10, 20, even 30 years from now. So let's start breaking them down one by one. At number 5, setting the stage, or should we call it a benchmark, is iShares Core S&P 500 ETF. Now, if I had to build a portfolio from scratch and could only choose one ETF to anchor it, IVV would be it. This fund tracks the S&P 500, which means you're getting a piece of the 500 largest companies in the United States. I'm talking about Apple, Microsoft, Amazon, Johnson & Johnson, and hundreds of other names that drive the economy. It's like owning a slice of the American business engine. What makes IVV so powerful is how boringly consistent it is, in a good way. It's not flashy, it doesn't shoot up overnight, but year after year, it keeps doing the job. Over the past 5 years, it's returned about 90%. Over the past decade, it's more than doubled, with a return of over 157%. That's an average of 9.87% each year. It does all of that with a rock-bottom expense ratio of just 0.03%, meaning almost every cent you invest is working for you. It also pays dividends, not huge ones, but reliable. Right now, the yield is around 1.43%, and those dividends have been growing steadily at about 6.95% annually. So while the focus here is on growth, there's also a nice layer of income quietly being reinvested in the background. Recently, the market has had some turbulence. Interest rate hikes, inflation fears, and global uncertainty have put pressure on even the biggest names. IVV has dipped slightly, but that's exactly when this kind of ETF shines. It's not built for drama. It's built for decades. When things are rough, you still own companies that make toothpaste, groceries, software, smartphones, things people aren't going to stop using. And because it's so diversified, one struggling sector doesn't tank your entire investment. Tech is down, healthcare might be up. Energy volatile right now? Consumer staples could be solid. This balance is baked into the fund, and it's why IVV is such a trusted core holding. Now let's talk about what that trust can actually grow into. Let's say John invested $100,000 into IVV and left it to grow. He doesn't add anything, doesn't withdraw, just lets it sit and reinvests its dividends. After 1 year, that money would grow to $111,300. After 10 years, it would be worth $287,181. Give it 10 more years, and in 20 years, it would climb to $801,131. That's when the compounding starts to work. And by year 30, John's original $100,000 would grow into $2,187,030. The total value added to his portfolio will be $2,087,030. Of that total, $1,933,898 would be pure capital appreciation. Dividends would add another $153,131 to the total. So yeah, IVV may seem plain on the surface, but when you look at the numbers and let time work its magic, it's anything but ordinary. Okay, so now let's move on to something with a little more edge, an ETF that knows how to shine when things get chaotic. I'm talking about the iShares MSCI Global Gold Miners ETF with the ticker symbol RING. This is the kind of ETF you want in your corner when the world gets a little crazy, which, let's be honest, it often does. RING doesn't invest in gold itself, it invests in the companies that dig it up. These are global gold miners, and they tend to thrive when fear starts creeping into markets. When inflation flares up, when governments print more money, or when global tensions rise, people start running to gold. And when gold prices rise, guess who profits? Gold miners. This ETF gives you exposure to some of the biggest gold mining companies on the planet in one single fund. It's definitely not a quiet, slow and steady performer. RING has a higher expense ratio than something like IVV, sitting at 0.39%. But that higher expense ratio is common for niche ETFs with more volatility. And speaking of volatility, RING knows how to swing. Let's look at its recent run. It's up over 50% year to date, when most of the ETFs are down 10 to 20% because of the tariff war. That kind of surge happens when the world gets nervous and gold becomes the fallback plan. Performance-wise, RING has returned over 61% in the past 5 years and more than 166% over the past decade, which means it's averaging around 9.98% price growth each year. Its current dividend yield is around 1.03%, and the dividend growth is strong, about 12.3% annually. So the question is, what could $100,000 do inside RING if you left it alone and let the market do its thing? After 1 year, it would grow to about $111,010. After a decade, it would hit $287,141. Let it sit for 20 years, and you'd be looking at $846,653. And by year 30, it'll be valued at a solid $2,580,800. The total value added to your portfolio will be $2,480,800. About $2,118,492 of that would be pure capital appreciation, and dividend reinvestment would add another $362,308 on top. Next up, I'll show you an ETF that pays over $20,000 in monthly dividend income, and in the end, I'll show you one of my favorite ETFs that can turn your $100,000 into a $13 million portfolio. At number 3, we have the iShares Core Dividend Growth ETF with the ticker symbol DGRO. It focuses on companies that don't just pay dividends but actually increase those dividends year after year. That growth is what makes this ETF so powerful. It's not just about getting paid now, it's about getting paid more and more over time. DGRO invests in U.S. companies that meet specific criteria around dividend history and sustainability. To qualify, a company must have at least 5 years of uninterrupted dividend growth, pay qualified dividends, and maintain an earnings payout ratio below 75%. It also excludes the highest yielding 10% to avoid risky dividend traps. This ensures the fund holds financially sound businesses that consistently and sustainably reward shareholders. At the moment, DGRO pays out a dividend yield of about 2.35%, noticeably higher than something like benchmark IVV. But it doesn't stop there. The dividend growth rate sits at an impressive 12.53%, meaning those payouts tend to increase year after year. And that's a big deal, especially if you reinvest those dividends and let compounding do its thing. The fund's long-term performance reflects that reliable structure. Over the past 5 years, DGRO has returned over 65%, all while keeping costs low. Its expense ratio is just 0.08%, making it one of the cheapest ways to access high-quality dividend growers. So not only are you getting strong companies with rising income potential, but you're also keeping more of your returns thanks to low fees. DGRO doesn't tend to swing wildly. When the market is euphoric, it might lag a bit behind more aggressive funds, but in times of uncertainty or correction, it usually holds up better. So what does the long view look like for an investment in DGRO? Well, let's say you start with that $100,000 and let it ride with no additional contributions. After 1 year, you'll be sitting at $110,630. In 10 years, that grows to $287,384. After 20 years, your investment would hit $942,114. And after 30 years, you're looking at a staggering $3,758,430. Out of that total, $2,101,908 comes from capital appreciation, but dividends do a whole lot of heavy lifting here. Reinvested over time, they add $1,556,522 to the pot. That's more than 15 times the original investment just from reinvesting dividends. And by year 30, your annual dividend income would be around $254,278, or about $21,190 in monthly dividend income. Next up at number 2, let's talk about the fast lane, technology, with the iShares Global Tech ETF. IXN is your gateway to the biggest tech giants in the world, not just in the US, but across global markets. When you invest in this ETF, you're essentially plugging into the innovation heartbeat of the planet. I'm talking about companies like Apple, Microsoft, Nvidia, and also massive non-US players driving the future of cloud computing, artificial intelligence, cybersecurity, and everything in between. Tech has changed how we live, work, and connect, and it's not slowing down anytime soon. When the broader market stumbles, the long-term demand for tech doesn't disappear. That's what makes IXN so compelling. It gives you a front-row seat to some of the fastest-growing companies on the planet, but spread out in a way that still offers diversification. Now, with that kind of opportunity comes a little more movement. IXN can be more volatile than broader market funds like IVV or DGRO, especially when interest rates rise or headlines around global trade tensions heat up. Recently, fears around new tariffs on tech components and concerns over rate policy have put some pressure on tech stocks, but that's often short-term noise. The long-term trend here has been incredibly strong. Over the past 10 years, IXN has delivered a return of 353.46%, which is an average 16.24% yearly growth. Sure, the current dividend yield is on the lower side, around 0.49%, but tech companies are increasingly starting to return capital to shareholders, and the dividend growth rate stands at a steady 7.17%. It's not the reason you buy this ETF, but it's a nice bonus. It's also worth noting the expense ratio here is 0.41%, which is a bit higher than something like IVV. But for what you're getting, it's a fair trade-off. You're paying slightly more to access some of the most dominant, innovative companies across the globe, all bundled into one ETF. So let's get to the good part. What does your $100,000 investment actually look like if you commit long-term? If you invest in IXN and let it ride with no additional contributions, your money could grow to $116,730 after just 1 year. After 10 years, that climbs to $463,363. Give it 20 years and it skyrockets to $2,109,894. But the real jaw-dropper is the 30-year mark, where your investment would grow to $9,542,575. From $100,000 to over $9.5 million. Most of that growth, $9,404,518, is capital appreciation. The rest comes from reinvested dividends, which still manage to add about $38,057 over 3 decades. It's not a dividend powerhouse, but that's not why you're here. Finally, at number 1, I have even more specialized territory, the ETF that taps into semiconductor chips powering every single tech device you've ever used. The iShares Semiconductor ETF. Listen, without semiconductors, there's no AI, no smartphones, no electric vehicles, no cloud computing. This ETF is laser-focused on the companies designing and manufacturing the tech that fuels the modern economy. And while it's a bit more intense than the others in this lineup, the potential payoff is massive. SOXX holds some of the most crucial semiconductor names out there, like NVIDIA, Broadcom, Intel, Qualcomm. These are companies building the infrastructure that every other tech company relies on. And because the semiconductor space is so critical and so cyclical, you get high highs, low lows, and huge opportunities if you can stomach the ride. In terms of recent performance, SOXX has also faced a bit of turbulence. Rising interest rates, fears of economic slowdowns, and most notably rising tensions over U.S.-China chip trade policies have weighed on the sector. The U.S. restricting advanced chip exports and retaliatory tariffs from China have created some near-term headwinds, but zoom out and the big picture remains crystal clear. Semiconductors are everywhere and becoming even more essential as AI, automation, and digital infrastructure continue expanding. Over the last 10 years, SOXX has returned an incredible 456.18%, meaning an average of around 17.48%, the highest among all 5 ETFs we've covered. That kind of long-term return doesn't come easy, and it doesn't come without risk. But for investors who can look past the short-term noise, the reward potential is in a league of its own. It currently offers a dividend yield of 0.85%, which may not seem like much, but its dividend growth rate is a solid 11.45%. The fund is also relatively concentrated with only 35 holdings, and over 60% of the portfolio is sitting in its top 10 companies. That adds to its volatility, but it also means your money is focused on some of the biggest drivers of future tech. The expense ratio comes in at 0.35%, reasonable for a targeted sector ETF with such strong returns. So, how does it all add up over time? If you and John invested $100,000 into SOXX and did absolutely nothing else, you'd see it grow to $118,330 after 1 year. Stick with it for 10 years, and you're looking at $529,301. In 20 years, it would climb to $2,730,730. And if you let it ride for 30 years, the growth projection hits a massive $13,895,328. That's a nearly 140 times return over 30 years. Driven mostly by capital appreciation, which alone accounts for $13,631,443. On top of that, dividend reinvestment adds another $163,885, slowly boosting the snowball over time. Don't have $100,000 in savings? No worries. Click the video on the screen to discover 3 dividend stocks that can surpass your full-time job with just a $50 a week investment strategy.